Let me tell you about a phone call I received in March of 2020 that changed how I think about market panics forever. I was sitting in my office, watching the screens turn red, and my phone rang. It was a friend of mine, a very successful investor, and he was panicking. He said, "Bill, I am selling everything. This is it. This is the end. The world is never going back to normal." I listened to him for about 5 minutes. And then I told him something that made him hang up on me. I said, "This is the greatest buying opportunity of our lifetimes." But that it had lost my mind. And you have to understand the context. The market had just dropped 30% in a matter of weeks. Companies were shutting down, people were dying. The news was absolutely terrifying. And here I was, telling one of my closest friends to buy stocks when everyone else was selling. But here is what I understood that he didn't. Markets don't reward you for following the crowd. They reward you for being right when the crowd is wrong. And the crowd is almost always wrong at the extremes. That friend of mine, the one who hung up on me, he sold his entire portfolio at the bottom. He locked in losses of over 40%. Meanwhile, I was buying, and over the next 18 months, those investments returned over 200%. I am telling you this story because right now, in early 2026, I am seeing almost the exact same setup. There are three sectors that the market has completely written off. Three sectors where pessimism is at extreme levels. Three sectors where I believe patient investors are going to make an absolute fortune over the next 3 to 5 years. And today, I am going to share exactly what those sectors are, why they've been beaten down so badly, and most importantly, why I believe they're about to stage one of the biggest comebacks we've seen in a generation now. Before I dive into the specifics, I want to explain my framework for identifying these opportunities. Because this isn't about guessing. This isn't about hope. This is about understanding how markets actually work and positioning yourself accordingly. You see, markets are driven by two primary emotions, fear and greed, and these emotions create predictable cycles that repeat themselves throughout history. With remarkable consistency, when things are going well, greed takes over. People pile into whatever is working. Prices get pushed to ridiculous levels. Everyone thinks the good times will last forever. Financial media celebrates the winners. Analysts raise their price targets. Momentum attracts more buyers. And the cycle feeds on itself until valuations reach absurd levels. Then something happens. Maybe it is an economic shock. Maybe it is a change in interest rates. Maybe it is a geopolitical crisis. Maybe it is just the natural end of a cycle. And suddenly, fear takes over. People panic. They sell indiscriminately. Prices collapse far below what the underlying businesses are actually worth. The same financial media that was celebrating now predicts doom. The same analysts who were bullish turn bearish. And the cycle reverses, pushing prices to equally absurd levels on the downside. This is where fortunes are made. Not at the top, when everyone is euphoric. At the bottom, when everyone is terrified. The greatest investors in history have all understood this. They've all made their biggest returns by buying during periods of maximum pessimism. The key is identifying when fear has pushed prices below intrinsic value. And there are three signals I look for when I am hunting for these opportunities. First, valuations need to be at historical lows. Not just cheap. Historically cheap. The kind of cheap that only happens once or twice a decade. I want to see price to earnings ratios in the bottom decile of their historical range. I want to see price to book values that suggest investors have given up on the sector entirely. Second, sentiment needs to be universally negative. When you can't find a single person who is bullish on a sector, that is usually a sign we're near the bottom. I pay close attention to fund flows, to analyst recommendations, to media coverage. When money is pouring out of a sector, when analysts are universally bearish, but the media is writing obituaries, but it's typically when the selling pressure is exhausted. And third, there needs to be a catalyst for recovery, something that will cause people to reassess their assumptions and start buying again. This could be a change in policy. It could be an improvement in fundamentals. It could be a shift in the competitive landscape. But there needs to be a reason to believe that things will get better. The three sectors I am about to share with you meet all three criteria. They're historically cheap, sentiment is absolutely terrible, and there are clear catalysts that I believe will drive a massive recovery. Let me start with the first sector. And this one might surprise you. It is healthcare, specifically biotech and pharmaceutical companies. Now, I know what you might be thinking. Healthcare seems boring. It is not exciting like artificial intelligence or cryptocurrency or whatever the hot thing is this week. But that is exactly why it is such a compelling opportunity right now. The boring out of favor sectors are almost always where the best opportunities hide. You see, healthcare and biotech have been absolutely crushed over the past few years. The major biotechnology indices are down nearly 50% from their highs. Many individual biotech companies are trading at prices below the cash they have on their balance sheets. Think about that for a moment. You can buy entire companies for less than the money they have in the bank. The market is essentially saying that these businesses are worth negative value, that their research pipelines, their intellectual property, their future potential are all worthless. That is a level of pessimism that rarely makes sense. How did we get here? Well, there are several factors, and understanding them is crucial to understanding why the setup is so attractive. First, interest rates rose dramatically from 2022 through 2024. Biotech companies typically don't generate profits in their early stages. They're investing in research and development, trying to create breakthrough drugs and treatments that won't generate revenue for years. When interest rates are low, investors are willing to fund these companies because the cost of capital is cheap. $1 of potential profits 5 years from now doesn't get discounted very much. But when rates rise, suddenly that future dollar is worth much less in today's terms. The math changes dramatically, and investors become less willing to bet on companies that won't generate profits for years. Second, there was a massive speculative bubble in biotech during 2020 and 2021. People were throwing money at anything with a pulse. Companies with no products, no revenue, and no realistic path to profitability were being valued at billions of dollars. Every week there seemed to be a new IPO or SPAC deal for some biotech company that had never generated a dime of revenue. That bubble had to pop. And it did spectacular. Third, there has been significant concern about drug pricing reform and government intervention in the pharmaceutical industry. Politicians have been talking about capping drug prices, allowing Medicare to negotiate directly with drug companies, and other policies that would reduce industry profits. This regulatory uncertainty has weighed heavily on the entire sector. Investors hate uncertainty, and there's been plenty of it. Fourth, we've seen some high-profile clinical trial failures that have shaken confidence in the sector. When a major drug candidate fails in late-stage trials, it doesn't just hurt that one company. It reminds investors of the inherent risk in biotech investing and causes them to reassess their entire exposure to the sector. But here's where it gets interesting. All of those headwinds are now turning into tailwinds. Interest rates have stabilized and are starting to come down. The Federal Reserve has signaled that the aggressive rate hiking cycle is over, and most economists expect cuts over the next year or two. This is hugely positive for biotech because it reduces the cost of capital and makes investors more willing to fund long-term projects. The math that worked against biotech when rates were rising is now working in its favor. The speculative excess has been completely wrung out of the market. The companies that had no real business models have mostly gone bankrupt or been forced to merge. What is left are the stronger, more credible companies with real products and real potential. The garbage has been cleared out, leaving behind the quality, and the regulatory fears have proven to be largely overblown. While there have been some changes to drug pricing policies, the impact has been far less severe than what the market was pricing in. The pharmaceutical industry continues to generate enormous profits, and innovation continues to be rewarded. The worst-case scenarios that investors feared simply haven't materialized. And here's the most important catalyst. And this is something that not enough people are talking about. The large pharmaceutical companies are facing a wall of patent expirations. Over the next 5 years, drugs representing hundreds of billions of dollars in revenue are going to lose patent protection. That means generic competition. That means revenue cliffs. And the only way for these companies to replace that revenue is through acquisitions. Big Pharma is sitting on hundreds of billions of dollars in cash. They have massive balance sheets and strong cash flows. They need to deploy that capital, and they need to do it quickly. The most efficient way for them to acquire new drug pipelines is by buying smaller biotech companies that have already done the research and development work. I am expecting a massive wave of mergers and acquisitions over the next few years. And when a small biotech company gets acquired, it is typically at a 50 to 100% premium to its current stock price, sometimes even higher. This is not speculation. This is how the pharmaceutical industry has always worked. The big companies buy innovation from smaller companies. Let me give you a specific example of how this works. A few years ago, I invested in a biotech company that was developing a treatment for a rare genetic disease. The stock had been beaten down because the company was burning cash, and people were skeptical about whether the drug would ever get approved. Sentiment was terrible. The shares were trading at a small fraction of their peak value. I did my homework. I spoke with doctors who treat this disease. I analyzed the clinical trial data in detail. I consulted with medical experts to understand the science. I became convinced that the drug was going to work and that there was a huge unmet need in the market. The stock was trading at a significant discount when I started buying. Within 18 months, a large pharmaceutical company acquired the business at a substantial premium. The returns were exceptional, multiple times our initial investment. Now, I am not saying every biotech investment will work out like that. This is a risky sector. Many of these companies will fail. Drugs don't get approved. Clinical trials disappoint. Competition emerges. There are genuine risks that need to be respected. But when you buy at the right time, when valuations are depressed and sentiment is negative, the risk-reward is massively in your favor. You are not paying for success, you are paying prices that assume failure. And when success happens, the upside is enormous. Right now, you can buy quality biotech companies at valuations we haven't seen since the financial crisis. Companies with approved drugs, with real revenue, with clear paths to profitability, are trading at single-digit price to earnings multiples. You can buy companies with strong pipelines and experienced management teams for less than the cash on their balance sheets. That is absurd, and I believe it represents one of the best opportunities I've seen in my career. The second sector I am extremely bullish on is commercial real estate. And I know, everyone thinks commercial real estate is dead. They think work from home has permanently destroyed office buildings. They think e-commerce has killed retail. They think there is a massive wave of defaults coming that will wipe out investors. And you know what? They might be partially right about some segments. But here is what the market is missing. Not all commercial real estate is the same, and the market is pricing everything as if it is all going to zero. Let me break this down because the nuance here is really important. Commercial real estate includes several different property types: office buildings, retail centers, industrial warehouses, apartment buildings, hotels, data centers, cell towers, self-storage facilities, medical office buildings. Each of these property types has completely different fundamentals, different demand drivers, different growth prospects. Office buildings in certain markets are definitely struggling. Vacancy rates in some major cities have reached levels not seen since the early 1990s. Some buildings are being sold at massive discounts to their replacement cost. And I'll be honest with you, I am not rushing to buy office buildings in downtown San Francisco or certain parts of Manhattan. That is a tough market that is going to take years to work through. But here is what people are missing. The best commercial real estate, the highest quality properties in the best locations, is actually doing just fine. Class A office buildings with modern amenities in prime locations still have strong occupancy. Companies are willing to pay premium rents for spaces that help them attract and retain talent. The flight to quality is real, and the best properties are benefiting while the mediocre properties suffer. More importantly, there are segments of commercial real estate that are absolutely thriving. Industrial warehouses have been on an incredible run, driven by e-commerce growth and supply chain reshoring. Every major retailer needs more distribution space. Every manufacturing company is rethinking their logistics. Demand for well-located industrial space is strong and growing. Data centers are seeing explosive demand because of artificial intelligence and cloud computing. Every major technology company is building massive data center infrastructure. The computing power required for AI applications is growing exponentially, and someone needs to own the real estate where all that computing happens. Multifamily apartments in supply, constrained markets continue to see strong rent growth. Housing affordability challenges mean more people are renting for longer. And in markets where it is difficult to build new supply, existing properties benefit from limited competition. And even in the struggling segments, valuations have collapsed to the point where the risk-reward is becoming very attractive. Properties that were selling for $300 per square foot 2 years ago are now available for $150 per square foot. At some point, prices become so cheap that even mediocre properties start to look interesting for the right buyer. Here is what I am watching closely. The commercial real estate lending market is starting to show signs of stabilization. Banks have largely worked through their troubled loan portfolios. The worst loans have been marked down or foreclosed upon. New lending standards are stricter, which means the properties getting financed today are higher quality, and there is an enormous amount of private capital sitting on the sidelines, waiting to deploy into real estate when the time is right. When that capital starts to move, prices are going to recover, and investors who bought at the bottom are going to make a fortune. I've been selectively adding to commercial real estate positions over the past year. Not indiscriminately. I am being very careful about property type, location, and tenant quality. I am focused on the segments that have strong fundamental demand, not the ones that are facing structural challenges. But the opportunities are there for investors who do their homework and are willing to be contrarian. Let me share a specific situation that illustrates the opportunity. There was a retail property in a major metropolitan area that lost its anchor tenant during the pandemic. The previous owner defaulted on the loan, and the property went into foreclosure. The bank sold it at auction for about 40 cents on the dollar compared to its pre-pandemic value. The new owner, a group I am invested with, spent some capital repositioning the property. They brought in new tenants that were better suited to the current retail environment. They made some improvements to the property. They stabilized the occupancy with a diversified tenant base. Within 2 years, the property's value had nearly doubled, and it is now generating a cash yield of over 12% annually. That is the kind of opportunity that exists right now in commercial real estate. Distressed assets being sold at panic prices by motivated sellers, banks and lenders who just want to get the problem loans off their books. If you have the capital, the expertise, and the patience, these are generational opportunities. Now, the third sector I want to discuss is perhaps the most controversial. It is emerging markets, specifically China and other Asian economies. I know what you are thinking. China has massive problems. The property sector is in crisis. There are geopolitical tensions with the United States. The government has cracked down on successful tech companies. Demographics are terrible with an aging population. Youth unemployment is high. Why would anyone invest there? And look, I understand the concerns. They're valid. China is not without risk. These are serious challenges that shouldn't be dismissed. But here is what I've learned over 3 decades of investing. The time to buy is when everyone else is selling. And right now, everyone is selling China. Chinese stocks are trading at valuations that are almost unprecedented. The major indices are down over 60% from their peaks. Some of the best companies in the world, companies with dominant market positions, strong cash flows, and excellent management teams, are trading at single-digit price to earnings ratios. You can buy these businesses for less than 10 times earnings. In some cases, less than 5 times earnings. That is extraordinary. And yes, there are real problems in China, but markets have a way of overreacting to bad news. The problems are real, but the prices have overcorrected to the point where they're pricing in a worst-case scenario that I don't think is likely to materialize. The market is essentially pricing these companies as if China's economy is going to collapse. That is not a realistic base case. Let me walk through the bull case because it is important to understand both sides. First, the Chinese government has enormous resources and tools to address economic problems. They've been gradually implementing stimulus measures, cutting interest rates, supporting the property market, and encouraging consumption. The policy response has been slow and measured, but it is happening. And when the Chinese government decides to stimulate, they have the ability to do so on a massive scale. Second, Chinese companies have become incredibly competitive globally. They're not just copying Western companies anymore, they're innovating in electric vehicles. Chinese companies are producing some of the best products in the world at prices that Western companies can't match. In batteries, in solar panels, in artificial intelligence. In advanced manufacturing, Chinese companies are world leaders. These competitive advantages aren't going away just because of geopolitical tensions. Third, and this is important, Chinese companies don't need access to American markets to thrive. There is a massive domestic market of over 1 billion consumers. As Chinese consumers become wealthier, domestic consumption is growing. There are growing export markets throughout Asia, Africa, the Middle East, and Latin America. The decoupling from the United States is a headwind, but it is not fatal. Chinese companies are finding new markets and new customers. And fourth, valuations provide an enormous margin of safety. When you buy quality companies at 5 or 6 times earnings, you don't need everything to go right. You just need things to not completely fall apart. At these prices, a lot of bad news is already priced in. The pessimism is reflected in the price. If things just stabilize, not improve, but just stabilize, these stocks could re-rate significantly higher. Now, I want to be clear. I am not suggesting you put all your money in Chinese stocks. This is a higher risk, higher reward opportunity. Position sizing matters. Diversification matters. These investments should be a portion of a diversified portfolio, not the entire thing. But for investors with a long time horizon and the ability to tolerate volatility, I believe emerging markets represent one of the best risk-adjusted opportunities available today. I've been gradually building positions in high-quality Chinese and Asian companies over the past year. Companies with strong balance sheets, dominant market positions, and proven management teams. Companies that I believe will be significantly more valuable 5 years from now, regardless of what happens with short-term sentiment. Let me share a broader point about investing that ties all 3 of these sectors together. The best investments are almost always uncomfortable. They require you to go against the crowd. They require you to buy when others are selling. They require you to have conviction in your analysis, even when the market is telling you you are wrong. When I made my bet on retail during the pandemic, people thought I was crazy. When I invested heavily during the 2008 financial crisis, my investors questioned my judgment. When I've taken contrarian positions throughout my career, I've faced skepticism and criticism. But that discomfort is exactly what creates the opportunity. If everyone agreed with me, the prices wouldn't be cheap. The bargains exist precisely because everyone else is too scared to buy. Now, I want to address a question I get all the time. How do you know when to buy? How do you know if you are catching a falling knife or if you are buying at the bottom? The honest answer is, you never know for certain. The bottom is only obvious in hindsight. Anyone who tells you they can consistently call market bottoms is either lying or delusional. What I focus on instead is valuation and margin of safety. I ask myself, what would this business be worth in a normal environment? And how much am I paying relative to that value? If I can buy a business at 50 cents on the dollar, I don't need to catch the exact bottom. Even if it drops another 20% before recovering, I am still getting an incredible deal over the long term. The key is having the financial and emotional ability to hold through volatility. This is why I always emphasize position sizing. Don't bet the farm on any single investment. Spread your capital across multiple opportunities. Have cash reserves to add to positions if they decline further. That way, even if 1 or 2 don't work out, your overall portfolio can still generate strong returns. Let me also address the timing question. People always want to know exactly when these beaten down sectors will recover. And the honest answer is, I don't know. It could be 6 months, it could be 2 years. Markets don't follow predictable schedules. They don't care about our timelines. But here is what I do know. Over the past 100 years, every time we've seen this level of pessimism, this level of valuation compression, this level of capitulation, markets have eventually recovered. Not every individual company recovers, but sectors as a whole have consistently bounced back from these kinds of conditions. The question isn't whether these sectors will recover. The question is whether you'll be positioned to benefit when they do. I've seen this pattern play out so many times throughout my career. In the early 2000s, technology stocks were left for dead after the dot-com crash. The Nasdaq fell over 70%. People swore they would never invest in tech again. The investors who bought quality tech companies during that period made fortunes over the next decade and beyond. In 2008 and 2009, financial stocks were trading at bankruptcy prices. Bank stocks were down 90%. People thought the entire financial system was going to collapse. Many of those companies are now worth multiples of what they traded for at the bottom. In 2020, when the pandemic hit, the world seemed like it was ending. The market crashed, people panicked, and within 18 months, stocks had more than doubled from the bottom. The same opportunity exists today in healthcare, commercial real estate, and emerging markets. These sectors have been through a brutal downturn. Prices are depressed, sentiment is terrible, but the underlying fundamentals of the best companies in these sectors remain strong. I want to close with a thought about patience, because this is perhaps the most important thing I can share. Investing isn't about getting rich quick. It is about positioning yourself for long-term wealth creation. The investors I know who have built real lasting wealth are the ones who bought quality assets at good prices and held them for years. That is what I am doing with these 3 sectors. I am not trying to time the exact bottom. I am not expecting immediate gratification. I am building positions in high-quality investments at attractive prices, and I am prepared to hold them for as long as it takes. The road to wealth is paved with boring decisions, buying when others are selling, holding when others are panicking, staying disciplined when the market is testing your conviction. It is not glamorous, but it works. These 3 sectors, healthcare, commercial real estate, and emerging markets, represent some of the best opportunities I've seen in years. The valuations are compelling, the catalysts for recovery are in place, and the sentiment is so negative that there is very little selling pressure left. I can't tell you exactly when the recovery will happen, but I am confident that it will. And when it does, the investors who had the courage to buy during this period of maximum pessimism are going to be very well rewarded. The market always recovers. The only question is whether you'll be positioned to benefit. I know where I am putting my money, the beaten-down sectors that everyone else has given up on, because that is where the real opportunities always are, not in the popular, crowded trades that everyone is piling into. In the forgotten, neglected corners of the market where fear has created bargains. That is how wealth is built. One contrarian investment at a time, one uncomfortable decision after another. It is not easy, but nothing worth doing ever is. And for those with the conviction to act when others are frozen with fear, the rewards can be extraordinary. These 3 sectors are going to bounce back. I am certain of it. The only uncertainty is the timing. But if you are patient, if you are disciplined, if you can hold through the volatility, I believe you are going to look back on this period as one of the best buying opportunities of your investing life. That is what I am betting on, and that is what I believe you should be thinking about too. But let me leave you with one more story that illustrates why contrarian investing works. But that 2009, at the absolute depths of the financial crisis, I was approached by several companies looking for capital. One of them was a major financial institution that everyone thought was going to fail. The stock had dropped over 90%. The media was predicting bankruptcy. Investors were fleeing. I spent weeks analyzing the company. I went through their balance sheet line by line. I studied their loan portfolio. I talked to management. I assessed the risks as objectively as I could, and I concluded that while the situation was bad, it wasn't terminal. The company had enough capital to survive. The government was providing support. And the underlying business, once you look past the crisis, was actually quite valuable. I invested a substantial amount of capital within 3 years. That investment had returned over 400%, 400%, not because I was smarter than everyone else, but because I was willing to do the work, to look past the fear, and to make an uncomfortable decision when others couldn't. That same discipline is what I am applying to these 3 sectors today. Healthcare, commercial real estate, and emerging markets are facing real challenges. But the challenges are not insurmountable, and the prices have fallen to levels that more than compensate for the risks. The key insight is that markets are emotional in the short term, but rational in the long term. In the short term, fear drives prices below intrinsic value. Greed drives them above, but over time, prices tend to converge with fundamental value. The businesses that generate cash, that serve real needs, that have sustainable competitive advantages, those businesses eventually get recognized by the market. All 3 of the sectors I've discussed today contain businesses like that. Biotech companies developing treatments that will save lives. Real estate assets that will house people and store goods and process data. Companies in emerging markets that will serve billions of consumers. These are real businesses with real value, and the market is giving them away. I've been investing for over 3 decades now, and if there is one thing I've learned, it is that the best opportunities always come disguised as problems. They come wrapped in fear and uncertainty. They require you to see past the headlines and focus on the fundamentals. That is what separates successful investors from everyone else. Not intelligence, not access to information, temperament, the ability to stay calm when others are panicking, the willingness to buy when everyone is selling, the patience to wait for your thesis to play out. These 3 sectors are going to recover. When they do, the investors who bought during this period of maximum pessimism will be rewarded handsomely. The only question is whether you'll be one of them, because the greatest fortunes are made not by following the crowd, but by having the courage to stand alone when everyone else has given up. That moment is now. These sectors are ready to recover, and I intend to be there when they do.